Welcome all. This is Josh Heil, CIO and CEO of Citizen Mint, and we're here with Lewis Green at Savvy Investments to talk to you about his role within the firm and also just how he got into wealth management overall. Thank you for joining us, Lewis.
Thank you. Thank you for having me.
Yeah, and so maybe you can just talk about your background and kind of your path into wealth management, and ultimately what led you to joining Savvy.
Sure. So actually, my background started from my father. My father prepared taxes for friends and family, so he really inspired me to start in finance. Where I started was at a company called Bankers Trust. I started in the back office there. Bankers Trust was acquired by Deutsche Bank. So I eventually worked my way from the back office to what's called a portfolio manager. Along the way, I pursued the Chartered Financial Analyst, the Certified Financial Planner designations, and became a financial planner and an investment advisor. From there, I joined the PNC Bank for about 5 years. Then I joined UBS for 3, and then finally really looking to go independent. So I joined Savvy in April of 2024. I wanted to become a fiduciary and really bring customized solutions to my clients. So I'm very excited to have joined Savvy, and things are working out great here.
And so just what's the difference between maybe a fiduciary and what you had experienced in the past and how you kind of like talked and sold to clients previously?
Yeah, sure. So a fiduciary is essentially the utmost trust that clients can have in us, right? We're always looking to be in their best interest. And I was a fiduciary pretty much for the most part of my career, right? Except for some time when I was at UBS. But I've always worked as a fiduciary, even in my mind. And technically, I was required to work as a fiduciary with my time at PNC, my time at Deutsche Bank. It was only my time at UBS where if I was selling product or selling a structured product, for example, or something of that nature, and that could, as a broker, that I wasn't required to work as a fiduciary.
Mm-hmm. And so what really drew you to Savvy? Maybe you can talk about that business model and how they came about and kind of their thought process around the marketplace going forward.
Yeah, sure. So Savvy's fantastic because it's supported independence, right? So they allow me to, bring my own brand, bring my own way of supporting clients to my clients. So it's been fantastic. They provide all the support, all the technology, all the infrastructure, which really allows me to serve my clients in the way that I want to the most. But having a brand, I couldn't have a brand at UBS. I couldn't have my own website. I had like an internal website. So Savvy supports all the marketing, all the technology, and they really let us do our own thing and brand ourselves the way we see fit. So it's been fantastic.
Mm-hmm. And so how do you think about branding yourself? Like what is your differentiation for your clients and what are you trying to talk to them about from a differentiation standpoint? Because I mean, like for the most part, wealth management can be commoditized in certain phases and factors. So how do you differentiate yourself?
Yeah, absolutely. I think that's a great question. So I wrote a book. I have a book out there called 5 Steps to Retirement Planning. And really, that book is the way I think about it in my work with my clients, right? So it's not just investments, it's tax planning, estate planning, financial planning, and lifestyle planning as well. So it's a really, and I know this term is overused, but it's a holistic approach to my clients or for my clients.
And what does lifestyle planning mean? Just for the normal kind of listener here.
Yeah, so a lot of it, the way I think about lifestyle planning is really focused on post-retirement, but it could mean much more than that, right? Making sure that their income could also be part of financial planning, but it's really just making sure that they're going to be able to live the way they want to live, right? Where are they going to live? Are they going to move? We help with a lot of that type of analysis, so big purchase analysis, Social Security, Medicare, but sometimes it's even like loneliness, right? Loneliness is a big problem for a lot of people here in America, especially older men, older women as well. Don't get me wrong. So it's covering those types of areas. Meeting with clients as often as we can to just talk about anything, not just their investments. And sometimes it's helping them in a divorce situation, right? Sometimes it's helping them with parents. Maybe parents passed away, or parents need help with investment and things of that nature. That's what lifestyle planning is.
Got it. And so what's the typical type of client that you're serving, and what is like, so just from a demographics point of view, do you serve younger lifestyle, older lifestyle? Is there any specific kind of like thought process around who you serve?
It's probably pre-retirees, right? So probably my core base is, anyone from 50 on, right? People that are professionals trying to navigate the end of their work career and also this pending or upcoming retirement. That's who we work best with. Don't get me wrong, some of our newer clients are younger professionals who are just getting started. We work well with them as well, but I'd say the core base is Brooklyn, New York, pre-retirees to post-retirees.
And how do you think about just building portfolios for these clients, and what are you kind of like building those around, and what are they asking for from a portfolio perspective?
That's a great question. So really what we do is we incorporate the investment planning with the financial planning, right? So when we're building a portfolio, we typically lead with beta, right? Low cost ETFs with portfolios that are managed by Savvy. And then we like to loop in alternative investments where they're appropriate. Again, these are not recommendations, but the clients that we work with typically have a combination of maybe some private equity, some private credit, maybe some hedge funds, maybe structured products, maybe buffered ETFs. But the core portfolio is typically low cost ETFs or single stocks, and everything is customized for them. We look at what type of return that they need to earn to achieve their goals, what type of risk they're comfortable taking from a quantitative and a qualitative perspective. That's how the portfolio process essentially starts.
And so from an alternatives perspective, how are you kind of building out those alternatives, or what are you thinking about when, like, from a client perspective? Is it evergreen structures? Is it interval structures? Is it drawdown funds?
Yeah, it's typically been the evergreen structure. That's been the more popular strategy recently, at least for our clients. I think a lot of the clients are, they want to have some type of liquidity. So it's nice to be able to tap into that for the evergreen funds.
Got it. And what percentage of portfolios would be in those kind of like structures, like from an alternatives perspective?
Yeah, it varies. I mean, it could be anywhere from 0% up to, I'd say, about 20%. Is typically the maximum. 20% might be a bit aggressive, but it all depends on the portfolio, the constraints. If we put together an IPS for them, their age, where they're at, a number of different factors. But I'd say 0 to 20%.
And what do you think? Maybe this is a little bit of a different question, but what do you think is the number one kind of value add of a financial advisor for these clients? I mean, most financial advisors say, like, well, it's financial planning, or it's investment management, or it's estate planning. What is kind of that biggest value add that they're getting?
Yeah, that's such a great question. It's a great question. I think it depends on the financial advisor, right? Me, I've done so much. Like, I've done trust work when I was at Deutsche Bank. Deutsche Bank was a trust company. I've dabbled in the estate planning. So I think if you have a good advisor who can do just so much more than investments, that's the value add. But if I'd say one thing, is just being that, that member of the family, right, that they can turn to for anything. And maybe I can't get the answers, but maybe I can get to the firm or someone else here at Savvy, or even someone in my network who can help. So that's really what it is. The way I think about it is getting them access to any questions that they have, whether I can answer it myself or the network that I have, or the company that I work for.
And so what about just the current questions you're getting from clients right now? Given today's market environment, there's some level of concentration risk at the S&P 500 level with like all these big companies, whether it's and SpaceX adding to that, and Anthropic and OpenAI could possibly add to that.
Yep.
How are you thinking about today's market environment for your clients? And like, how does Savvy play into that for your decisions on like how to position clients?
Yeah, so a lot of clients are asking questions, about the tech space, about all these exciting new names, right? Should we be in them? How much should we buy? How much can we purchase? What's the appropriate amount of risk? So that's definitely one part of it. And the way Savvy helps is really by giving us access, right? So diversification strategies, option strategies, long, short, direct indexing. So Savvy actually provides the platform. They get us access to these names. But also there are other advisors here who we can tap into, and we can have conversations with other advisors through a Slack channel, and we exchange ideas on a regular basis. So that's been great.
Got it.
Yep.
And what about just thinking about diversification for your clients? Like how do you think about that? Like, is that just and I guess like liquidity needs for your clients? Is there any specific rules you put into place for any individual clients? And I would assume that's their goals and kind of the financial management of those goals over time.
Yeah, these are great questions. So you don't want to diversify just for the sake of diversifying, right? You don't want to diversify, or as some people call it. I think you want returns that don't match. So you want low correlations. So that's where some of the other products, some of the alternative investments come into play. I think it's very important. You mentioned earlier, liquidity is a big function of the portfolio that we put together. So if we're using alternative investments, we want to be mindful of how liquid some of them are, but we're always designating parts of the portfolio for their short-term liquidity needs, other parts for their medium-term goals, and then some of the more liquid stuff for their long-term goals. So we're really looking at a comprehensive portfolio for them.
Mm-hmm. Okay, and maybe just to help our kind of listeners, what should investors or advisors rethink today? Like, is there anything that they should be thinking about differently than they maybe had been traditionally thought about in the past? Maybe you can start with that.
Yeah, I think the biggest thing, there are a lot of things, right? One of the biggest things that I hear all the time is it too late, right? The market has rallied this year and last year. Is it too late to get in? So I really look at that, and I speak a lot about timing, how difficult it is to time the market, what you should do when markets are volatile, right? You should be comfortable with the amount of risk you're taking at all time, right? But just be mindful of volatility and trying to predict things based on other factors, right? So many clients say, look, I don't like the political climate, I don't like what's going on in the world. And I say, look, it's just very hard to time that. Be mindful of the risk, but don't be afraid of investing at almost any market, right? As long as you're comfortable with the risk you're taking. That's part of the biggest thing that I tell clients all the time.
So on that question, so what would you say? Dollar cost average into the market for a new client, or go in all at once?
Yeah,
that's always the discussion to have.
It's insane. And usually when you pick something, the opposite works best, right? Like I had a client who put some money in recently, and we were trying to dollar cost average it, and we essentially flipped course, which I didn't want to do. But as we reevaluated things, we found out, hey, look, you're comfortable with this risk. We were very smart about the portfolio, but I think you go all in. Again, as long as you're comfortable with the risk and you know what might happen, right? So we know, if you're all in, you could be down 30 or 40%, right? How old are you? There's something called sequence risk, which is very important, and we tell clients, look, that's something that you need to pay attention to, right? If you are just out of retirement and the market drops 30% and you're tapping that portfolio for income, that can be a big problem for you. So, those are things that you need to consider. But I think for me, for the most part, it's just not dollar cost averaging. But again, taking into consideration your comfort level with the risk you're taking.
Yeah. What's one kind of planning or investment mistake that can be avoided with better advice from a financial advisor?
Yeah, it's probably. I mean, there is a lot. I'm trying to figure out what's probably the what we just talked about, the emotional investing. There's so many
Yeah.
clients that I talk about not selling. I remember during COVID, I had a client. He was a business owner, and he said, "Look, I know what's going on in China. Sell everything." And I said, "Look, does it make sense to sell Disney, or does it make sense to, again, not a recommendation of any stock, but he had some good quality names in there that I thought, hey, look, no matter what happens, it doesn't make sense to sell these stocks." Um, but to answer your question, I'd say the emotional investing, keeping them invested.
Yeah. I think that is like keeping invested is like the number one value add advisor because like people are emotional and they get to the point where they want to sell everything. An advisor keeps them invested, and then the market rebounds, and then they're like, usually they forget about that they wanted to sell everything. They're like, oh yeah, it was me.
Exactly.
But, yeah.
Yeah, you're right. You're 100% right.
So what about wealth management in general? Where do you think the market's headed for wealth managers over the next 3 to 5 years? How do you think AI plays into like how wealth management is done with clients over that time period?
Yeah, no, a lot of it's been, so a lot of my time here at Savvy, we're definitely, going head on with AI. So I've been seeing some of the amazing things that we've been doing on the back end. We're able to work with our clients at scale because of the infrastructure that Savvy has put together, and AI plays a big role in that. The way we're able to present financial planning recommendations has sped up because of AI. But the way I see it going forward is data collection. Right, data collection is going to be easy to gather going forward. So we'll be able to make decisions at a much quicker pace than we have in the past. I think to me that's probably the big thing. What if analysis, different tools that we have available that can provide different outcomes for clients, or analyze different outcomes for clients, I should say.
Yeah,
but definitely encouraged by AI.
and do you think it changes like how many advisors are out there, either positively or negatively?
Yeah, I think AI is going to be positive for the advisors, to me. And I think it's going to expand the number of advisors because a lot of advisors previously, like if you were on your own, you probably couldn't. AI is going to just make it that much easier for you to be successful. And I think there's enough. There's enough clients who need advisors where we're not really going to be hurt by AI. It's just the way I see it right now. But I think AI will be a plus for the industry.
Mm-hmm. And where do you think, like just from a Savvy perspective, how are they going after the market in general to just differentiate themselves from what else is out there? I know you mentioned technology is one place where they're trying to do that. Investments maybe one place they're trying to do that. But anything else that we should be mentioning?
Yeah, I think what I love about Savvy and what they're doing is they're giving our clients this boutique approach, right? They're empowering the advisors, and that allows us to spend more time with our clients, and really spend less time on the things that just don't have any value for them, right? The account opening process, all those other things that take our time away from the great work we do with our clients. So I think that's what Savvy is allowing us to do. And to me, that's the most important thing. I don't think there's anything more important than that client relationship and that face-to-face with that client. And Savvy, with all the things that they're doing, is just making that much easier for us. And we're bringing that value to the clients.
Yeah. What about the advisor-client relationship? How do you think that evolves over the next decade? Because there's certain clients after COVID who were like, "Hey, I don't want to meet with you. I just want to do it on Zoom, and I don't meet with you as often." And so, or newer clients are like, "Hey, just send me a text or a video," and that's how they want to interact. How does that change over time?
It's funny. One of the advisors who works here, I think he put something on a Slack channel where he was it was something in reference to clients and how often they want to meet and how they want to meet. And I think he was surprised that so many of them want to meet virtually. And I was a bit surprised by that as well. But I think a lot of clients now are very comfortable. I think they have to know you. They have to know who you are. You have to have a relationship with them in some way, some form. But I think a lot of clients are just like us, right? Do I need to get in my car and drive an hour, or do I need to get on the train? If I trust you, just like you and I are having this conversation, there's nothing wrong with doing it over Zoom. We should
Yeah.
meet in person maybe once a year or maybe once every 2 years. But I think it makes things a lot easier for clients. To your point, clients can text me. We have a compliance phone, right? My compliance, my business phone is monitored by compliance. They can text me, and they like that as well. It gets some very quick response times. So I think this is making it great for everyone.
Yeah. Okay, switching gears a little bit, because I like to ask this question. So what's one thing that most people don't know about you, or a hobby that you have?
That's a good question. Let's see. I played high school baseball against some people who went pro, like Manny Ramirez and some of these big guys, and so that's probably one hobby I think that people don't know about me, unless you know me pretty well. I bragged about it, being destroyed by a bunch of like future major leaguers in baseball, like 25-2 or something like that. And I think I had this one catch where it was like an over the shoulder catch, which in my mind, like I think I went blank, and a scout came up to me and said that was the greatest catches that I've ever seen, and it was just complete luck, to be honest with you. So that's a fun story.
Yeah, no, that's great. So anything else you want to leave us with before we end this right here?
I think, first of all, thank you for your time. I appreciate it. It's been great just knowing you and being on this call. And, I think if it's from a client perspective, don't be afraid to, reach out and have a relationship with advisors or, of course, Savvy or myself. I think when it comes to having a financial advisor, don't be afraid to be in that relationship, right? Like I still pay for my taxes, for example.
Yeah.
I meet with someone and, I enjoy working with her.
Yeah.
So, clients shouldn't, they shouldn't be discouraged by that. There's a lot of what I read, a lot of fraud out there, right? Which still surprises me. I know that's the way we're going, but people still need to be protected, I think.
Yeah. Yeah. No, that's great. Well, we appreciate the time, and thank you so much for joining us today. And we'll end it there.
Great. Thank you, Josh.